The Federal Reserve yesterday cut its key interest rate by a quarter point for the first time since 2008. Now, Fed Chairman Jerome Powell declared it was just a mid-cycle adjustment, causing the stock market to drop and rates to firm. Now, while it was a widely anticipated move, economists are now confused about what's next following Powell's announcement. To tell us more, I have Associate Editor Vikram Khanna. Welcome, Vikram.
Thank you, Haryanto.
And this is the first time that we are doing TBS together.
Yes,
right?
That's the first time.
So happy to have you here. Now, Vikram, tell us a bit more, right? What were market expectations before the Fed's announcement?
Well, just to back up a little bit,
Yeah.
there had been 9 rate hikes from the end of 2015 up to July, up to this latest Fed move. So that was one thing. The second thing was that the chairman of the Fed, that's Jerome Powell, in the lead up to the rate decision, had put out a lot of somewhat negative news about the prospects. For example, he talked about how inflation was undershooting the target of 2%. He talked about global headwinds in the form of uncertain trade policies. He talked about weak growth in China and Europe. And these began to weigh on people's minds. You know, they came to expect, I think, a resumption of an easing cycle. So that's what they were expecting.
Right. And why did the Fed disappoint the markets?
Well, the Fed put out what you could call a mixed message.
Okay.
On the one hand, the U.S. economy is doing quite all right. I mean, the growth is so-so. It's not bad. It's about 2.1% in the second quarter. The jobless numbers are, unemployment figures are not bad at all. In fact, unemployment is at a close to 50-year low at 3.7%. And consumer confidence is doing quite all right. It's still holding up. On the other hand, there are some early signs of weakness. The manufacturing sector is not doing that well. Business investment is not doing that well. So that's on the positive side. But on the negative side, you do have inflation undershooting the target. It's 1.6%. The target is 2%. So that's a worry. And I think the Fed chairman is afraid that it could get worse. Inflation could get lower. And then you have trade tensions, which have been ramped up just today, with President Donald Trump tweeting that there's going to be 300 billion worth of tariffs on the remaining Chinese imports. And then you have Europe is in very weak shape. Its economy is in close to deflation. And the European Central Bank has basically said there's going to ease policy further. And Japan is already in negative interest rate territory. And so is Europe, by the way.
And Vikram, you know, are there signals that the Fed is giving about future monetary policy? You know, they're being ambiguous. Why is it so? And of course, you know, what does this mean for investors then?
Is it being ambiguous? Well, yes. And I think it has no choice, actually. Because on the one hand, it's facing domestic tailwinds from the U.S. economy. And on the other hand, it's facing these global headwinds from Europe, from the trade uncertainty, and so on. And so Jerome Powell said, he made it clear that this is not the start of a long easing cycle of rate cuts. But then he added, but I didn't say this is going to be the only one. So that sort of threw people, made people
it's very confusing.
Right? So where do things stand? So I think markets are on kind of tenterhooks. As to where this leaves investors, I think investors are in a bit of a quandary. I mean, on the one hand, the equity markets, at least in the US, are quite frothy still. I mean, the S&P's PE ratio is about 20, and forward looking is about 18. The bond yields are 2%. They have collapsed, basically. Actually, they're below 2% for the 10-year bonds in the US, the treasuries. And then in Europe, bond yields are negative in many countries. So equities are risky. I mean, you can still go there, but it's a bit of a risk given these headwinds. And you're not going to get much return on bonds. So where do you go? I mean, you could explore emerging markets. emerging markets, but then emerging markets too, like in our region, we are also exposed to the trade war.
Yeah.
So we are also, facing headwinds.
Headwinds as well.
Although there is room for emerging market bonds to do well because they are still yielding positive.
Right.
And there is room for them to do interest rate cuts. So, which would help bond prices.
All right. So thank you once again, Vikram, for coming onto the show to really share a bit more about the announcement by the Feds. Now, of course, it is a very heavy topic, but you've managed to, simplify it, make us understand a bit better of the situation. Again, these are still in its nascent stages, the announcements and all that. We still don't know what's going to happen. So just make sure that you keep track of the news on our website at straitstimes.com. Once again, thank you so much, Vikram, for coming on to the show.
Thank you, Arianto. It's a pleasure.